Hey guys, it's Mike and welcome to the Imbalance course. This is Module 1 and I'll be talking about what imbalances are, why they are important, and how they are formed. Now before I begin, let's go through a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than their initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so, I miss the days of the trading pit, honestly. It was a lot of fun. It was great hours. You come in at 7 in the morning, leave at, if you weren't on the 2:30 train home, you were considered late. So the one thing about I missed the most was the open. And, that was to me the best part of the day. Seeing how the markets, open up higher, open up lower, if traders are being aggressive, seeing how the flow of orders is coming into the market. On the screen, it's not very eventful. It's maybe eventful if something big happens over the weekend. The last big eventful reopening, I think, for me was the back in March. I forgot what year that was, 2008, when JP Morgan came out and said they were buying Bear Stearns for like $2 and it became $5. And remember, this was just before the market opened. And, you could just sense the panic that was going on in the markets. Now, the markets just open up on a Sunday night and it just starts trading, pretty uneventful. Now, seeing the traders and order fills aggressively buying the offers or selling the bids in the pit, I think really gave a trader an insight into market direction, at least in the near term. And with electronic trading, you don't see whether, the big hedge funds, whether they're buying or selling. But when there was a trading pit, you could, if you knew who the underlying customer was trading through certain brokers, you can, have a fairly good idea if it was Paul Tudor Jones, for example, buying 1,500 lots of S&Ps. Because, maybe that broker only had one or two big clients and one of them just happened to be Paul Tudor Jones. Now people say, well, they got inside information. Honestly, it's very easy. The easy way you can tell is when the broker brings down Paul Tudor Jones on the pit because he wants to see the trading pit. Well, then once you see the big guy's customer, then okay, well, I know that the Paul Tudor Jones trades through this broker. So when that broker's got big orders, there's a fairly good chance it's him. And on the screen, you can't tell. You can't tell that. You can't tell like if a big hedge fund like Bridgewater or whatever is doing the buying or selling. But on the trading floor, it was easy to spot. And there's even some guys, such big traders that they even had their own clerks. People that are just dedicated to handling their lines. So if you saw a particular clerk pick up the phone, you knew that trader was going to be active. And the thing was, again, there's a lot of movement. Used to be a lot of movement on the trading floor. So, someone would go from one firm to another firm and oftentimes bring their client. And, that's how people can know that, certain clients traded through certain firms. But, on the screen, it's a little bit more anonymous. You're going to see big orders chewing through the market. Like you can see here, like you see, wow, I got this big stack selling imbalance here. And then down here, you got to see some more selling imbalances. Now, price action traders, I don't need order flow because I can see, I got a big red candle, so I know they're selling. Well, yeah, look at what's happening. Market sold off, rallied back up, and just went sideways. At this point, you got to decide, is the market going up or going down? And if you're looking at the screen, you can see, well, what do I have here? I got mostly selling imbalances. Okay, chances are better that the market's going to go down than go up from this double bottom here. Now, one of the misunderstandings of order flow, I think, is you watch a lot of videos and everyone says, well, you can see what the big boys are doing. Well, okay, yes, you can see what the big boys, the institutions are doing in the market, but you don't see the underlying trader or the firm. Oftentimes you're left to guess, is it a big stop order going through or is it a real money account trading? But really what you want to do is you want to see it, right? You want to see it in the order flow imbalances. You want to understand to pick it up. And honestly, if you're looking at time and sales, if you're looking at a trading dome, watching each tick go through, you become numb to it because you just see so much noise going through. You see 2 lots, 5 lots, 1 lot, 8 lots, 12 lots, 6 lots, 2, 3, 4, like that. But with the footprint chart, I think it gives you a more, how to say it, a better categorized, or takes that information and puts it into an easy to read format as you're seeing on the footprint chart. Now, all activity, not just institutional activity, shows up in the two-way auction in the form of imbalances. Now, the one thing I want to stress, right, is the whole purpose of me putting this course together, as well as the other courses like on Delta, is I want to teach you the thought process that goes on during the trading day, not just to say, well, you got to stack buying imbalance, you have to buy here, or you got to stack selling imbalance, you got to sell there. No. Most people new to trading, new to order flow, want to be shown where to buy and where to sell instead of learning how to understand and interpret what's happening in the market. And, the best way for me to describe it is, there was an actor, I forgot which one it was, Sir John Gielgud or something like that. He was like in a movie with, what's his name, Dustin Hoffman. Dustin Hoffman is, these method actor types guys. I'm trying to get into the character. I want to know what he feels, and doing all that. Where, Sir John Gielgud says, well, son, why don't you just act, right? And it's the same thing with trading, right? When you know how to trade, you just trade. You don't sit here and try to interpret, what's this moving average mean, or what does this RSI thing mean? You just you know what's happening in the market. And the interesting thing is, ever since I released some of these courses, like the Delta course, I get people messaging me saying, look at, they'll send in a chart and they'll like mark it up and say, oh yeah, you got this one going on here, this going on there. But they understand, based on the setup that I've given them, the series of setups, that they understand why the setup exists, what the meaning of it is, and they recognize it now, so they could read what's happening in the market much better. And that's the whole point of me putting together these little mini courses on order flow, is to get you up to that point where you can understand what's happening in the market as it happens. Now, most traders are familiar with imbalance because they've studied market profile. And in market profile, the market is either balanced or it's out of balance, period. There's basically two states. And when dealing with order flow, you're looking specifically in a bar and seeing when the market is imbalanced at a moment in time, or whether it's out of balance. And most of the time, a bar is just a bar. It's not out of balance. It's when you see imbalances occurring that it means something. And a few years ago, I wrote this book, Trading Order Flow, on order flow, and it was really the first book that dealt with futures trading with order flow. And I see people trying to analyze it, my weekend, they'll post it up on Twitter or Instagram, my weekend reading, and then they'll post this stuff, how they'll have discussion with some other people saying, well, they're trying to compare order flow with market profile, and it's really two different things. Market profile, I think, deals with the market on a little bit macro sense in the day time frame, whereas order flow deals on the micro sense in a bar, right? And there's a big difference there, right? With market profile, is based on 30-minute intervals, whereas order flow, I think, it deals with more bars on bar by bar, like that. Whereas sort of taking with market profile, you're sort of taking more of a general approach, whereas order flow deals with more a micro approach. So what order flow imbalances, how they're caused, is when there are more aggressive traders than buyers. Now, there's 4 types of traders. Hopefully you understand this by now. To me, this is very basic. You have aggressive traders, you have passive traders. What's the difference is aggressive traders want to get into a trade. Passive traders, they're willing to get into the trade if the market comes to them. So aggressive buyers are the traders who buy at the market. They buy the offer and the next offer. Aggressive traders sell at the market. They sell into the bid and the next bid oftentimes. And people say, well, why are they going to sell into the next bid, or why are they going to buy the next offer? That's stupid. They're not going to do that. Well, you got to remember, right? The market's a two-way auction. It could be 20 lots on the offer and someone's got 25 lots to buy. So they're going to buy the 20 that's on the offer, and then they're going to buy the next offer. Oftentimes, they're just not going to wait and sit here and say, well, okay, I'm going to bid here for the balance. Some do, But big traders don't. Just get me done, right? If it's, they don't care if they can buy 80% at one price and 20% at the next level. They're fine to do it. And passive buyers are the opposite. They're the people that are going to sit there and let the market come to them. They work limit orders on the bid. They work them below the bid. If they get filled, they get filled. If they don't get filled, it's not the end of the world. Later they'll readjust their position, and the next day come in with a different level to buy at. So once you understand that, then you're on your way to becoming a better trader. So the market's trading in a two-way auction. There's a bid, there's an offer. So as you can see here, right, it's 27.10.5 bid at 27.10 3/4. 241 on the offer. There's 85 on the bid. Below the bid, there's 149 lots bid at 27.10 1/4. There's 822 bid at 27.10. On the offer side, there's 562 at 11, 691 at 27.11 1/4. So passive buyers are the buyers on the bid side and below the bid, below the best bid. Passive sellers are sellers on the offer and behind that offer. But if it's just going to sit like this, there's not going to be any trading, right? Someone needs to be aggressive. Be aggressive, right? That's the key. For a trade to happen, either the passive bidder has to become aggressive and buy the offer. So someone that's working at 27.10.5 bid has to say, you know what, I want to get done. I want to just get me done. I want to buy this. And they buy it at 27.10 3/4. They go to the market on their order. And a passive seller, someone that's working at 10 3/4 can say, oh, this market's going to drop. I don't want to miss I don't want to miss this 10.5 bid. So they move their limit order at 27.10 3/4 down to 27.10.5. They become the aggressive seller. And that happens a lot. There's also market orders that come in. A market order to buy one at the market is just going to lift the 27.10 3/4. That's an aggressive action. Or a market order to sell is going to come in. It's going to sell it at 27.10.5. If the 10.5s are gone, it's going to fill it at the next available level, which is 10.25. So that's the difference between aggressive buyers and passive buyers, or aggressive traders and passive traders. So an order flow imbalance is going to occur when there are more aggressive buyers than aggressive sellers, or more aggressive sellers than aggressive buyers, based on trades on the bid versus the offer diagonally, not horizontally. In the old days, they used to compare it horizontally. You can't, right? Because it's a two-way auction, right? It's a bid against an offer. And on an order flow chart, generally, the selling imbalance is going to be a red color number in the volume footprint, or buying imbalance is going to be a blue number in the volume footprint as opposed to a black number. Again, most software will allow you to adjust that, but I think it's fine with red and blue. And just keep all of the volumes black. So how do you determine it's a buying imbalance? Well, again, you're comparing this 22 against 134. You're not comparing 124 against 134. It's 22 against 134. This is your imbalance here. So what traded on the bid versus what traded on the offer, you have an imbalance, a buying imbalance. More offers were lifted than bids sold. Now up here is a selling imbalance. It's 3 against 178. It's not 178 against 229. It's 178 against 3. 3 lots traded on this offer up here versus 178 here. So you have selling imbalance. You have more aggressive sellers than aggressive buyers. You only have 3 aggressive buyers. Here you got 178 aggressive sellers. And again, it's horizontally, not, it's diagonally, not horizontally. So what causes an imbalance? Well, I just said, a buying imbalance occurs when there are more aggressive buying orders coming into the market. A selling imbalance occurs when there are more aggressive selling orders coming into the market. And why they're coming in is not important to an order flow trader. What is important is recognizing and identifying they're coming into the market. Now, knowing there's an imbalance occurring is going to give you an edge over other traders that are oblivious to the fact that there's an abundance of orders coming in one direction that's moving the market. If you're looking at a normal bar chart and you see, oh, it's an up candle, you're thinking all the buying is aggressive, right? Because it's up, right? Well, there's different intensities of trading that's going on. It could be very strong or it could be very weak. And I think it's very important to make that distinction if the buying that's going on in an up candle is very strong by a certain percentage over the selling that's going on in that bar. And remember, right, we all know this, it takes large orders to move the market. Large orders come from large traders. Oftentimes, when you have a group of small traders, small retail traders that are trading 1 lots, 2 lots, 5 lots, that's not going to move the market. The trader at a bank that's got an order to sell 3,000 E-minis is going to move the market. Whereas, maybe you might be a price level where there's a lot of retail activity, but majority of the time, overwhelmingly the majority of the time, it's going to be the large orders that are going to move the market. The big, large traders, the institutional traders, generally speaking, are the money that has the conviction and is going to move the market. And there's a guy who's quite popular in market profile circles. I'm not gonna name his name, but I agree with a lot of what he says. But there's one thing that I don't agree with is he says there's no directional trade anymore in markets like the E-minis, which I think is just complete nonsense. I know for a fact there's directional trade and big directional trade in the E-minis, and they think now it's all noise, like it's all hedge, spread against one market versus another market, like E-minis versus Euro stocks or something like that, or NASDAQ. No, there's still directional trade in there, and it's still quite big. So the other important thing to remember is to get the most out of order flow imbalances, you have to think similar to institutional trader causing the imbalance. Is an imbalance coming at a level that we're breaking out of, or did we just sell off and hit a low and now all of a sudden you're seeing aggressive buying coming in? When you start thinking in context of the market, it's going to make it a lot easier to understand the strength of the imbalance that you're looking at. And understanding where the market is currently trading relative to key reference points and, more importantly, value is also going to help you. Not just thinking, well, are we at a high or a low, but understand where we are trading relative to other factors, like a monthly high or a monthly low, or the middle of yesterday's range. Is important things to keep in mind with what's going on in the market. So this is a great example, right? This market's selling off, hits this low, starts rallying up, then boom, you got stacked buying imbalance. But if you're looking at this low, anytime you hit a low, you got to start asking yourself, what's going to happen? Are we going to continue lower, or are we going to turn around and rally? Okay, and what's one of the clues is imbalances. Okay, first time you hit this low here, this bar right here, with the 2 buying imbalances in it. I wouldn't call this one earlier with this number 0.75 a low, but this one, yeah, okay, I'm willing to say maybe it's a potential low. I would look at it and say, okay, I got 2 buying imbalances. Possibly we could be forming a low here. Well, then what I'll do is I'll look at the next bar. What do I got? I don't have any more buying imbalances. I got 1 selling imbalance, not a big one. It's 8 against 0. Okay, so I'm not necessarily convinced between these 2 bars that this is a low, right? Because for a market to move away from the low, you need aggressive buying being in control. Okay, so what happens is you make a new low, you got more selling imbalances, 2 in this bar. This next bar, selling imbalance there, 144. Then you got another green bar, okay, 2 buying imbalances. Okay, potentially a low. What happens in the next bar? Well, there's no buying imbalances, but it's green, it's up. Okay, next bar, 2 buying imbalances. Okay, so now I'm seeing 2 at the low, 2 in a bar, right off the low. And then the next bar is kind of mixed. It's a red candle, but you got 1 buying imbalance in there. I wouldn't worry about that. But then this next bar here, you got stacked buying imbalance. You got 4 buying imbalances in this bar. So if you take this, what's happened here, right? Is there any selling imbalances? No. Just prior to that, it was mostly selling imbalances. Now you're seeing all buying imbalances coming in. So you could feel a lot more confident that we're putting in a low. Right? Now, again, I'm not saying that it's something that you could pick up right away, but when you're trying to take it in context with the market, that's what's happening in the market, on a bar by bar basis, you're not going to say, well, I got 2 buying imbalances, this is a low. No, you start putting the bars together, right? It's like a puzzle. Okay, I got a couple buying imbalances, nothing in this bar, then a couple more buying imbalances, then a stacked buying imbalance. Okay, you got, look at this, 1, 2, 3, 4, 5, 6, 7, 8, 9 imbalances over 4 bars, 5 bars. And no selling imbalances. If anything, I'm going to say this is a low. That I don't think we're going lower because everything is pointing that we're going higher. Now, there's going to be times where the market's going sideways and you see imbalances. Did this imbalance work? Yeah, it worked. Look, I mean, we have this imbalance in here around 54.73, and we traded up to 54.96. So yeah, you could say, yeah, that worked, but it wasn't a great move. I prefer moves like this where it's like coming in off of a low and starts going higher than a market that's just going sideways. A market that just goes sideways, it's got a chance of working, it's got a chance of not working. I think it's better when you can really understand it better, in the sense that, yeah, we've got to swing low rather than it's just coming in here in an area going sideways and it worked out. Okay, fair enough, it worked out. Now, the general market consensus, and again, it's not set in stone, is that an imbalance is formed if the more aggressive side outnumbers the less aggressive side by a ratio of 4-1. And again, there's no law that says it has to be 4-1. You could use 10-1. You could use 5-1. You could use 3-1. I wouldn't go below 3-1 because remember, right? It's got to be aggressive trading in a certain direction. 3-1 isn't really showing much aggression. But 4-1 is what a lot of people use, and I'm fine with it. Now, depending on your order flows, your order flow software, your volume footprint chart, some make it easy to see the imbalances, others a little bit more difficult. So this is the settings for the indicator on the order flows trader software, my software, not the NinjaTrader platform. I don't use it. I have no desire to use it. Now, my order flows trader sits on the NinjaTrader platform, but the NinjaTrader has their own native order flow tools, which a lot of people have told me leaves a lot to be desired. So anyway, the imbalance trigger in percent, you can see it is here, 400. If you want to set it at 10-1, you'd be 1,000. Now on Sierra Charts is a great program, but it's a little hard to use, especially if you're coming from other software, because you're not going to be familiar with a lot of the inputs. But is this one column 1% compare thresholds 444? If I wanted to make it 10-1, I'd make it 10-10-10. So again, then you got to play around with the colors. I'm not going to get into that. That's probably a whole nother half-hour video on. But if you have going to use order flow, go to Emoji Trading. My friend Lee runs that, and if you're not, just tell him I set you up with, tell him I sent you, and he'll set you up with whatever specials he could give you. But it's a little bit harder to understand, but once you understand it, it's a good software. It works, right? That's the important thing, is making sure the software works. And it's important to know that there's a time decay of sorts with order flow imbalance, and as time goes on, the imbalances lose their importance. I don't expect an imbalance to hold all day long. I view it like lighter fluid to get a fire started, right? Lighter fluid, you got a pile of charcoal, you want to get it started, you squirt some lighter fluid on and throw a match, right? You're not going to barbecue your meat with a pit full of lighter fluid. And an imbalance, I expect the market to move rather than just sort of go sideways, right? Once I see a buying imbalance, I expect the market to be going up, not going sideways or going lower. And remember, if a big buyer comes in and the market doesn't or can't rotate up, that could be a sign of a change in the bias. And that's important. Again, a lot of people don't realize it. They think that, I got a stack buying imbalance, we got to go higher. Well, understand, if it doesn't go higher, that's important information as well, right? If you have something that is shouting out at you saying, I got so many aggressive buyers coming in here, maybe it's a big order, but it can't sustain it, then it's probably not going to be a very effective move, and instead you can fade it. But that's something that's going to come with time, by watching the markets, looking at charts. Now, again, time decay is a term that people use, with options. Just like delta is a term that people use with order flow and with options, but it has different meanings. When I say time decay, doesn't mean it gets more important. Instead, what I'm saying is, as time goes on, the importance of the imbalance wears off. Don't look for it to come back to that imbalance level an hour later. If it's not holding soon, then it's probably not going to hold. And what I like about order flow, and I think it's why I gravitated towards order flow, is because it's very visual and allowed me to understand the dynamics of what's occurring in the market at a glance, and especially true without the trading floor, right? I said in the past you could see when big traders were active or not, and a lot of traders didn't make the transition from the pit to the screen. They just couldn't do it. They suffered. So order flow, I think, is a great tool that helps those traders especially understand what's happening in the market. Now, imbalances, and especially in its extended forms like stacked imbalance or multiple imbalances, are easy to identify and determining what's happening in the markets. So there are limitations, though, of imbalances, and a big limitation is when the market's in fast market mode. In the past, before before a lot of these like NinjaTrader stuff came out, it was just mostly CQG or Reuters. Now CQG, if the market was fast market, would put an F next to the quote on the screen, so you knew the market was fast market. And the reason it's why a market is quoted as fast market, at least when there was still the pit, was the data, the key punchers couldn't keep up with the price movement, so they designated it as fast market. And fast market would happen when there's a big data release, like the jobs numbers, non-farm payroll, or like say in crude oil API numbers, or when someone came out and said something unexpectedly, market go in fast market mode. And what it looks like on the chart, you look at the chart and you think, oh, your chart is broken. It's not. It's because the trading system can't keep up with it. If with NinjaTrader, I'm sure you've seen times where you get filled on a stop order and the market hasn't traded there yet, and you're sitting there looking at your screen for like a few seconds, then it catches up to it, but you're already filled. Now, generally you're not going to trade through a number, and you should know when numbers are coming out or data releases are coming out. I always get a kick of seeing these 23-year-old trading gurus that have been trading Forex for 6 months that know everything talk about how they trade through these numbers. Experienced traders, they don't trade through numbers. I remember on the floor watching when the Fed would come out with their announcement, like it was like a 1:10 in the afternoon or 1:20. The only phones that would be ringing are the phones from the retail brokers, the Refcos. Well, the Refcos doesn't exist anymore. The Lind Waldock companies like that. But the dealers, their phones, they're not even being quoted the market because they're not interested in trading through what the Fed is doing to the interest rate. They're willing to let the market settle down, and then they're going to start trading again. But on things like NinjaTrader, this is what it looks like. You're thinking, oh, Mike, your software sucks. Look at this. It's this. It looks like this. You got these weird looking bars. Well, the reason why it's like that is because NinjaTrader and the data feed can't keep up at the same time with how fast the data is coming out. You can see this is 7:30 right here to right here. You got this big burst of quotes coming through. This is crude oil. This is at 10 a.m. And basically from here to off the chart here, you get all these bars and all this movement from 78 up to 18. That's like what, a 30-cent move in how many seconds? And it just can't keep up with it. So it's not that the software is broken, but you've got to understand what a fast market is, right? So take these imbalances with a grain of salt. You're probably not going to be interested in these buying imbalances up here or these selling imbalances here because something was said or something came out at this time. So that's the end of Module 1. In Module 2, I'm going to discuss individual imbalances, stacked imbalances, and multiple imbalances. So I'll see you guys all in the next lesson. Bye-bye.